I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So this month we thought we'd look at what happened in January and then move into what could be happening in February and for the rest of the year, kind of an overall yearly outlook. And finally touch base on a couple of more administrative things that are happening within the team, having to do with tax and all that good stuff. So to start with, January was quite a bumpy month. A lot of activity happened. I mean, if you think back, and all this just happened in a month, but if you think back to the riot at the Capitol building in the United States on January 6th, we saw Biden, take the oath of office on the 20th. Then we had all the stuff happening south of the border, well, and BlackBerry in Canada, but with GameStop and all that excitement. It really was a very, very interesting month. One of the things we really found, which we can't put our finger on it completely, but the performance was actually very strong in the month considering the equity markets were down. So right now we're looking at a good start of the year. We hope that continues. But as I've been telling everyone as we've been doing the reviews, don't get used to these type of returns. I mean, in a lot of cases, the portfolios can't keep on going up 1 or 2% a month forever. There will be a period of time where we'll have some volatility. That being said, we are still optimistic for the future. We feel that there is a very good chance that the U.S. will be done the majority of their vaccinations by summer, and which will mean that the world's biggest economy will be able to open up. In Canada and a bunch of the other areas of the world, that might not happen. So it'll be interesting to see what the difference is going to be in countries and in business and how that all plays out throughout this year. But the volatility is going to continue. There's still people becoming sick with COVID-19, and there unfortunately is still people dying from COVID-19. So until we have all the vaccines kind of in everybody's arms who want to take them, then I think at that point we're going to continue to have lockdowns from time to time, or at least a curtailment of economic activity. Going forward towards the end of the year, I don't think it'll happen sooner than that, but it might. I mean, that's the thing about guessing or making predictions. You never know. But one of the things about the rest of the year is that you could start to see some inflation coming in. And what that'll do is it'll potentially create a concern that the Fed and really all the banks in the world are going to have to raise their interest rates in order to stop inflation from getting too out of control. The Federal Reserve in the United States has said that they would like to have inflation maybe a little bit higher than they are comfortable with for a short period of time. But if that gets carried away and the inflation really is dramatic, they'll have to act. The first way that they will most likely act will be to stop the money printing, stop the quantitative easing. That's the idea that the Fed is buying bonds from the Treasury. So the Treasury issues the bonds, the Fed goes ahead and buys them, whether it's in the open market or directly from them. And what that does is it adds support so that they can continue to essentially print money going forward. And like I said, at some point they'll stop that. I think they'll telegraph it quite well, meaning that they will let the markets know far enough in advance that they can prepare for it. I don't think that they'll want to do much in the way of surprises. So although we're a month late, one of the things that I did want to share today was some reading that I did over the holidays and into January. And I picked 3 or 4 different kind of lists that I wanted to share that I thought were quite interesting. The first list, there's a Nobel laureate by the name, and yes, I'm referring to the list, so if I look down, there's a person by the name of Daniel Kahneman, who's a Nobel laureate who was made famous by a recent book, and he really transformed the fields of economics and behavioral economics in particular. And so he's very much a numbers person, almost to a fault. Socially, he is very awkward and just a numbers person. So he had 4 interesting points that I wanted to share in one of the commentaries, one of the articles that were written about him. The first is that optimism is the engine of capitalism. But one thing he says is don't trust people, trust algorithms. And the idea behind it is that algorithms beat individuals about half the time, and they match individuals the other half of the time. So there's very few examples of people outperforming algorithms in making predictive judgments and making predictions. So we can all talk about, well, what we think is going to happen in 2021 or 2022, but the reality is a computer model will have better chances of getting it right than people will by making guesses. The other thing he says is take the broad view of things. Don't get too specific. When we're looking at this, he says that the single best advice is make sure we're broad framing it. See the decision as a member of a number of decisions you'll have to take. So make an overriding decision, and then that might mean that you have to make a bunch of other decisions. Test for regret. Regret is probably the biggest enemy of good decision making in personal finance. So assess if we're prone to having regret when we make a decision. The more potential for regret, the more likely you are to probably be better suited towards a lower risk strategy with your investments. And then the 4th item he says is seek good advice. Really, he says the ideal advisor, which I thought was interesting. I'm not sure I completely disagree or agree with it, but he says the ideal advisor is the person that likes you but doesn't care about your feelings. So in other words, he's basically saying he's going to give you the truth. He's not going to sugarcoat it. He's going to be blunt. He or she is going to make sure that they give that information to you. The second of 3 kind of learnings that I took away was from a fellow by the name of Charlie Munger. Now, a lot of you don't know Charlie Munger. Charlie Munger has been Warren Buffett's right-hand person for essentially 50 years. So when you look at Charlie and Warren, it's really the 2 of them together that created Berkshire Hathaway. Even though Warren Buffett's the one that gets all the credit, Charlie's really been the stay-at-home defenseman for the number of years that they've been partners. And he has some really, and Charlie, by the way, is I think he might be in his 90s now, like Warren. If not, he's just about there. And he says, I just try to avoid being stupid. I have a way of handling a lot of problems. I put them on what I call my too hard pile. Then I just leave them there. I'm not trying to succeed at my too hard pile. So here's a person that's one of the richest people in the world, who shares one of the greatest track records in the world of investing, and he has a too hard pile. So I thought that was interesting. Maybe in our lives we can do something similar. I'm not sure how applicable it is, but I thought it was interesting. And then I'll just run through these 10 rules when you're making predictions. So again, in the future, I talked about Daniel Kahneman, what he does. Here are 10 rules that came from Dan Gardner and Philip Tetlock's Super Forecasting novel, I guess novel book. 1, data matters. 2, don't make extreme forecasts. 3, reversion to the mean, or in other words, if something gets too far out of the norm, that'll come back to the norm, is a very powerful force. We are creatures of habit. We very rarely fall off a cliff. A full stomach does not riot. The first goal of political and business leaders is to stay in power. The second goal of political and business leaders is to get rich. Remember Occam's razor. Quite honestly, I don't understand or don't remember that one, but somebody out there might. And don't follow rules blindly. So, all that's to say, I guess, even though I started making predictions of what we think is going to happen in 2021, it really is a very tough thing to make predictions. Our view is that we create portfolios in order to take advantage of any opportunities that arise, but at the same time, we allow enough leeway in the portfolios that if we don't make a big bet in one direction or another, so that if we are wrong about a certain event, then it's not going to really cost the portfolio a whole bunch. At the same time, if we're right write about a whole bunch of events. That'll be good, and the portfolio will benefit, but it's not as if we're going to, all have 100% returns, because we know what happens with 100% returns is they can become 100% losses if you're not careful. The interesting thing I will say before moving to a few other items is that one of the biggest concerns I have at this point, and really why in portfolios we are still have a conservative bent, is this idea of how much debt is out there. There's two sides to this. On one hand, there's a lot of cash sitting in people's bank accounts, either because they can't spend the money or because they see the value of their investments have gone up quite a bit last year. But the other thing is that there's a lot of margin debt out there. And a margin debt, as a reminder, is the amount of money that funds or individuals will borrow in order to invest. The idea that, I'll buy 2 shares of a particular stock, but I'll use the investment firm's money for the second share. I'll buy 1 share and the investment firm will buy the second share on margin. So that if something does happen, then I make a lot more money because I'm using borrowed money. On the other hand, if something happens to the negative, you can lose a lot more money. And so margin debt is can be very problematic, because in times when the market takes a big drop down, people have to sell their investments in order to pay their debts. And that could be very negative for the market, as you can imagine, if everybody's selling at the same time. So one of the things that the Wolf Richter, author of the Wolf Street blog, came out with back at the end of January, so the numbers might be a little bit different now, but he came out back in the end of January, is the amount of margin debt that's in the United States. And so just in perspective, back in the year 2000, there was about, so right before the big drop, there was about $300 billion in margin debt outstanding. In 2008, again, right before the big drop, there was about $425 billion in margin debt. And now, or again, as of January the 22nd, there was about $775 billion in margin debt. So, needless to say, those are very big numbers. And that's not to say that the market's going to go crashing or it's going to go way down. And even if it does, it could be temporary because of all this cash sitting over on the other side. But it's just another sign that maybe things are a little bit too optimistic. And so when things are too optimistic, there's more of a chance to be wrong. And that's one of the big reasons why we prefer to be a little bit more defensive in portfolios these days and look at taking advantage of opportunities as they present themselves going forward. So the other thing I wanted to touch base on was the tax side of things. As we moved this year from Richardson Financial in February to Canaccord Genuity, that means that people had investments at both places in fiscal 2020. So there is the potential for getting 2 sets of tax slips. What we decided to do as a team, and Heng Yi and Angela have been working very hard on this for the last little bit, is to create a customized checklist for everyone. So you'll all receive a checklist that will outline exactly what you should expect to receive as far as the tax slips go this year, and where we anticipate them coming from, i.e. whether they're coming from the company directly, the investment company directly, whether it's coming from Canaccord or whether it's coming from Richardson. So we plan on having that out to you by the beginning of March. Just as a reminder, you'll receive your first batch of tax slips kind of at the end of February. That'll be your T5s, your transaction summaries, for capital gains and losses. And then in the companies, individual companies have until the March the 31st, so the end of March, to actually come out with their tax slips. What we've seen happen in the past is most of them are done. There might be 1 or 2 stragglers, but most of them are done by mid-March. So, like I said, we hope to have the checklist done, vetted, and sent out to you, and then we'll obviously keep you up to date if anything changes with those checklists. From time to time, some of these companies can do amendments, or they may be delayed in mailing or whatever. But as in prior years, please just have your accountant or tax preparer contact us directly, or you can give us a shout or send us an email, and we'll get duplicates sent out to you via email, or duplicates sent out to your tax provider preparer as soon as possible. So we're here to kind of support that. Like I said, the other thing other than tax is our client review meetings. So we've been obviously having those in January to start the year off, and that'll continue out for February, etc. For February, we'll be doing all virtual meetings still. We want to respect the wishes for people that, respect the government rules to make sure that we aren't in unknowingly spreading something to one of you. So we definitely want to keep not only the legal part of the rules, but the spirit of the rules as well. And so one of the things we'll do is we'll evaluate things towards the end of February to see what we do in March and whether we give an option to do it in person or not. But like I said, for February, I think it's better for all of our healths and for the spirit of the rules to just do virtual meetings. Virtual meetings can be Zoom or phone. We could also do an email review if that's something you'd like to. Just let us know. Angela, as you know, will reach out and book these a couple of weeks in advance, so that there's lots of times for us to prepare, but there's also times for you to set the time that works best for you to have that review. So in summary, we do expect a lot of volatility in 2021. 2020 was surprisingly a decent year for the markets. The last few months have definitely helped client portfolios by quite a bit. I was going to say we expect that to continue, but I don't know if we do. I think we expect the volatility to be there, but even if we do see a big drop in the markets, we would expect that to be relatively short-lived. So we're really focused on just making sure that we're keeping things safe at this point and always looking for opportunities to increase returns, however that may come in a risk-effective way. As normal, please do reach out to us if you do have any questions. Jim or myself are more than happy to set up a meeting or just answer questions on the phone or over email. And definitely feel free to pass this along to anyone who you feel might be interested in sitting down with us virtually to go through what their portfolio is all about and to talk to them, whether it be friends, family, colleagues, about anything that might be missing in their financial planning side of things. So thank you, and have a great day.